Every major bank in Australia now agrees on one thing. RBA is about to hike rates. Yet at the same time, new data out this week shows 87% of property professionals still expect prices to rise in 2026. The gap between rate risks and confidence is the most important story in the market right now. This isn't based on vibes or headlines. It's straight from the majors research desks and one of the largest housing sentiment surveys in the country. CBA, Westpac, NAB, and ANZ have all updated their calls since the hotter than expected December CPI print, and they're now united in expecting a February rate hike. At the same time, Totality's new Decoding 2026 report released this week shows nearly 9 out of 10 agents, bankers, and property professionals expect prices to rise this year. Most of the nightly news will give you those two stories completely separately. What they won't do is connect them together. That's what we're going to do now. Because when you put those two pieces together, higher rate hike expectations and still strong price expectations, you can see the pressure points forming before they show up in the charts. In this week's updates, we'll break down why the majors flipped a unanimous hike call after Wednesday's CPI and what they think happens next, what's really behind 87% bullishness from people on the ground, and how this confidence risk mismatch could create both opportunities and landmines for investors over the next few months. And toward the end of the video, here's an aha moment where these threads converge into one simple takeaway: what you should be watching, not rushing to do before the RBA meets. So let's start with what actually changed this week. On the back of the December quarter CPI print, which came in hotter than the RBA's own forecast, all four major banks have now lined up behind a February rate hike. Until a few days ago, the economist camp was split. CBA and NAB were leaning towards a February hike, whereas NAB and CBA were still in the wait and hold camp. That completely changed after the inflation data. Here's the key line from Westpac's economist team this week. December quarter inflation had the casting votes and voted yes hike. RBA to raise cash rates at February meeting to 3.85%. Commonwealth Bank said something similar. Now, they now expect the RBA to lift the cash rate by 25 basis points to 3.85% next meeting as well, calling it a fine-tuning move. A one-off hike to steer inflation back toward target rather than start of a new tightening cycle. In other words, the majors are now aligned on three key points here. The CPI result was uncomfortably high, especially the trimmed mean, which is what the RBA actually targets. A 0.25% rate hike tomorrow is now their base case, not just a risk scenario. For now, most of them still see it as a one and done, unless inflation keeps up and keeps surprising to the upside. Money markets responded immediately. The probability of a February hike moved from around 60% pre-CPI to the low 70s afterwards. So compared to last week, the big change isn't the inflation numbers themselves. It's the fact that the four institutions that set and distribute most of the country's mortgages are now publicly on the same page about what happens next. Now, a 0.25% move doesn't sound dramatic in isolation, but the reason it matters for property is where it's happening in the cycle. The cash rate is currently 3.6%. A move to 3.85% would be the first hike since late 2023 and would come after a period where the popular narrative had quietly shifted to the next move might be down. Westpac's note this week spells out the psychology. The RBA had effectively prepared the ground in recent weeks, warning that if trimmed mean inflation stayed above target, they'd act. December gave them not one, but 2 quarters in a row of core inflation above forecast. This isn't just another quarter point. It's a signaling move. It tells the market the RBA is still prepared to lean against inflation, even with higher mortgage stress risk. It resets expectation for when the first cuts might arrive, pushing that timeline further out, and it gives the banks cover for the fixed rate repricing wave we talked about in last week's update. For investors, that signaling is often more important than the actual 0.25%. Sentiment, especially around borrowing capacity and serviceability, can shift faster than the raw numbers itself. Now, here's where the story takes a bit of a turn. While economists have been getting more nervous about inflation and rates, housing sector confidence has stayed surprisingly strong. Totality's Decoding 2026 report dropped this week. It surveyed more than 1,100 professionals across the real estate, banking, broking, and related property sectors at the end of 2025, and the results are blunt. 87% of respondents expect dwelling values to rise over 2026. Only 3.5% expect prices to fall. Almost half of all respondents expect price growth above 5%. That's not retail investor optimism. That's the view from people running open homes, approving loans, and pricing deals every day. The confidence isn't evenly spread though. Queensland, Western Australia, and South Australia are the most bullish. In Queensland, 89% of the respondents expect prices to continue to rise, with more than half tipping growth over 5%. WA and South Australia show similar patterns, optimism underpinned by better relative affordability, tight rental markets, and solid population growth. New South Wales and Victoria are still net positive. Around the mid-80s% of respondents expect prices to increase, but the tone there is more conditional. High price levels and stretched borrowing capacity mean confidence is much more rate sensitive. So coming into a likely February rate hike, the market starting point is very strong confidence that prices rise in 2026, but increasing awareness that rate settings and affordability could cut into that if policy or borrowing costs move the wrong way. So let's connect the dots in terms of cause and effect. So lending and demand. Banks had already started moving on fixed rates before this week. We covered that last time. What changed now is that the majors are effectively telling borrowers, we think the RBA will move too. That shapes consumer behavior. Some buyers will try to get deals across the line before their pre-approval expires, or before borrowing capacity is reassessed at a higher test rate. Others will step back, especially at the margin in Sydney and Melbourne, where serviceability is already stretched. Policy and behavior. At the same time, the early expansion of first home buyer support, like the higher Sydney cap on the 5% deposit scheme, is still working through the system and is one of the reasons KPMG and others remain bullish on 2026 price growth. The Totality report notes that more than 3/4 of agents reported a lift in activity following the first home guarantee expansion, with competition intensifying around the scheme's price threshold. So even as rate expectations shift up, policy still has the lower and middle segments of the market running hot. Now, on the supply side, looking at pricing pressure. Nothing meaningful has really changed this week, and that in itself is important. There's no major new approvals data and no surprise policy to fast track stock. The same structural imbalance Totality's Tim Lawless pointed out to in their report, where new dwelling supply continues to lag population growth and is still doing a lot of the heavy lifting for prices. In other words, demand settings move week to week. Supply is still stuck in slow motion. This is the aha moment for this week. On one side, you have all four majors now publicly expecting a February rate hike. Market pricing shifting decisively towards tighter policy. Inflation running hotter than the RBA's own forecast for 2 quarters in a row. On the other side, you have 80% of the industry professionals expecting prices to rise this year. Nearly half expecting growth above 5%. And highest confidence concentrated exactly where fundamentals look the strongest: Queensland, WA, and South Australia. So the paradox is this: the people closest to the market are still largely bullish despite acknowledging the rate risk. Why? Because from their perspective, the supply-demand imbalance and policy settings are doing more to support prices than single 0.25% hike is likely to knock them down. For investors, that disconnect is both a risk and an opportunity. It's a risk if you assume that confidence guarantees price growth regardless of what happens with inflation and rates. It's an opportunity if you understand that sentiments can turn quickly if there is a second or third surprise in inflation later this year. This week didn't give us that second or third surprise, it gave us the first one and the market's initial reaction to it. Now, to cut through the noise, let's be explicit about what didn't move this week. Auction results. The latest detailed New South Wales auction data from SQM is still for the week ending 18th of January, with a clearance rate just over 40% on a small sample. We've seen a fresh national post-CPI clearance rate just yet. So We can't honestly say auctions have cooled or reaccelerated off the back of the inflation shock. That data will lag. Vacancy rates and rents. SQM's national vacancy data is still anchored on December, around 1.4% nationally. With no new January vacancy release yet, weekly rent trackers in some cities update, but there hasn't been a structural shift in the last 7 days. And supply metrics. No new building approvals data, no surprise announcements of major planning reforms. November's approvals uplift and the general supply still lagging demand story remain intact, but on change. So why does this stability matter? Because it tells you the underlying structural forces, tight rental markets, sluggish new housing supply, and a pipeline of demand-supported policy are still there in the background. Tomorrow's RBA decision is a cyclical shock on top of those structural settings. If you only watch the rate move and ignore the unchanged backdrop, you'll misread the medium-term picture. So heading into next week, here's what investors should actually watch. Not rush to act on. The RBA decision on Tuesday, but especially the language. Do they frame a hike if it comes as a one-off, fine-tuning move, or do they keep the door open to further tightening? The majors are expecting a hike and a fairly hawkish statement. 2, market reaction in auction clearance rates and buyer inquiry. Over the next 2 to 3 weekends, we'll see whether buyer depth in rate-sensitive markets like Sydney and Melbourne softens or holds. That's a better signal than any signal headline. Any early talk of additional policy tweaks. With confidence still strong and supply still constrained, keep an eye on any renewed debate around tax settings, investor policy, or additional support for first home buyers. That's where the next big structural shift is likely to come from, not a quarter point here or there. Next week's update will be all about how the market digests whatever the RBA does on Tuesday. If these weekly updates are helping you to separate signal from noise, and especially what's like on what actually changed this week, hit like, drop a comment, and with what you're watching ahead of the RBA decision. So subscribe, you don't miss out on the follow-up. And if you're looking at your own position thinking, I don't know if my borrowing capacity, my cash flow, or my next move still makes sense anymore if rates go up to 3.85%, that's exactly what Investor is built to help with. Inside the platform, you can model different rate scenarios, stress test your portfolio, and get structure around your next property decision instead of guessing. There's a link in the description. If you want more than tools and you like to talk it through, you can also book a call with the team. The goal isn't to hype you into buying, it's to give you the clarity so you can make decisions that still stack up, even if the RBA does what the Big Four think it will tomorrow. Thank you for watching.